Hey everyone, welcome to my channel. Today I'm breaking down the differences between three popular savings accounts in Canada, the TFSA, RRSP and the brand new FHSA. These accounts can be confusing as they work differently. In this video, I will cover everything you need to know about each of these accounts. So let's get started. First, let's just start with what are they for. The first one is TFSA, Tax-Free Savings Account. Think of this as your flexible savings account. Since it was rolled out in 2009, the TFSA has become one of the most popular ways to save. The good part is you can use this account for anything. Let's say for short-term goals such as buying a new car or a down payment, or even long-term goals such as retirement, you can use TFSA for all of these. Canadian residents who are at least 18 years old and has a valid SIN number can open the account. Next, RRSP, Registered Retirement Savings Plan. RRSP are primarily for retirement savings, but they also offer a valuable tax deduction in the present. RRSP can also be used for home buyers plan or lifelong learning plan. Individuals who earn income can open this account, and there is no age restriction. The third is First Home Savings Account, FHSA. FHSA is for first-time home buyers to save for a down payment on their first home. Think of this account as a mix of TFSA and RRSP benefits, but with a focused goal of buying a home. You must be at least 18, a Canadian resident, and a first-time home buyer. I have recently made a video about FHSA. If you want to learn more, click the link up here. Now let's understand how contribution rules work for each of these accounts. With TFSA, you contribute after tax dollars, and there's an annual contribution limit which changes each year. So for example, 2025 you have a limit of 7,000. The contribution room accumulates each year even if you don't contribute, and you can carry forward unused room. For example, if you have never contributed to a TFSA, you can contribute up to 102,000 to your TFSA in 2025. This is because your contribution room has been accumulating since TFSA first started in 2009. This room is only for those who were at least 18 years old in 2009 and a resident of Canada, of course. But if you arrived in Canada in later years, your contribution room starts from the year you become a Canadian resident. Now with RRSP, you contribute pre-tax dollars. This means your contributions reduce your taxable income, giving you an immediate tax refund. The contribution limit is based on 18% of your previous year's earned income, up to a limit set annually by the government. For example, let's say you earned 60,000 in 2024 and you did not make any other contributions to a pension plan. You can contribute 10,800 to your RRSP in 2025. Contribution room carries forward if unused. With FHSA, you contribute pre-tax dollars similar to an RRSP. There is an annual and lifetime contribution limit. The annual contribution limit is 8,000 and the lifetime limit of 40,000. Unused room can carry forward but only up to 8,000 per year. And on the taxation side, for TFSA, the big draw here is that any investment growth and withdrawal are completely tax-free, and the government does not take a cut when you pull out the money, even if it grows significantly. With RRSP, your investments grow tax-free within the RRSP, and you only pay tax when you withdraw the money in your retirement. Ideally, you will be in a lower tax bracket then. If you withdraw prior to retirement or for any other reason except home buyers plan or lifelong learning plan, you will be taxed. With FHSA, if you withdraw money to buy a qualifying first home, it is tax-free. But if you withdraw for anything else, same rule as RRSP applies. Now let's talk about withdrawing your money. On TFSA, you can withdraw anytime for any reason and without taxes. The withdrawn amount is added back to your contribution room the following year. With RRSP, withdrawals are taxed as income except under specific programs like home buyers plan and lifelong learning plan. And also, early withdrawals are generally discouraged due to tax implications. You will have to pay withholding taxes and income tax on the amount you have withdrawn, as CRA considers this as income. Any amount you withdraw from RRSP, the room is permanently gone. Withdrawals cannot be redeposited. You will lose the room permanently except for home buyers plan or lifelong learning plan. However, with home buyers plan, you need to pay back the money within 15 years, otherwise you will be taxed. With FHSA, withdrawals for a qualifying first home purchase are tax-free. However, non-qualifying withdrawals are taxed similar to RRSP. Let's say if the money is not used to buy your first home within 15 years of opening the account, you can transfer this to an RRSP, or you can also withdraw the money, but again you will have to pay taxes. Let's say you withdraw from your FHSA and you have some leftover money in that account. That money can be transferred to RRSP or RRIF on a tax-free basis. However, once you take out all the money from your FHSA, you must close the account within 1 year. Now let's understand the limitations of each of these accounts. With TFSA, there's an annual contribution limit and it changes every year. Over contributions are taxed at 1% per month on the excess amount. Any amount you withdraw in a given year, you contribution room is lost for that year. There are some situations where taxes apply, such as if you receive dividends from a US stock, you'll need to pay taxes. Contribution made to a TFSA is not tax deductible. With RRSP, withdrawals are taxed. Contribution is based on earned income, and there is a deadline for contributions each year. The contributions you make on RRSP will reduce your income that may affect government benefits, and you must convert to a RIF or annuity by age 71. With FHSA, the limitation is you can only use this account to buy a first home. If you already own a home, you can't really open this account. Contribution deadline is calendar year, meaning you will only get tax slips for the contributions made from January to December. Funds must be used within 15 years of opening an account or by age 71. Now let's talk about some key advantages of these accounts. With TFSA, it is flexible. You will get tax-free growth and withdrawals, and also it is suitable for various financial goals. You do not need to have an income to open this account. TFSA contribution room grows every year, even if you don't file a tax return or even if you don't open a TFSA. With RRSP, you will get an immediate tax savings due to the tax deductions on your contribution. Tax deductions can also be deferred for a future tax break. For example, if you're just starting a job and there's a possibility of earning higher income in coming years, you could defer the tax deductions and use it when you earn a higher income to get a more tax break. With FHSA, contributions are tax deductible, and you will get tax-free withdrawals for a first home purchase. Now the big question is, which one is right for you? There's no happy path. Each of these accounts serves a unique purpose. It depends on your individual circumstances and financial goals. For example, if you are saving for a down payment on a home, the FHSA is a no-brainer. For general savings and investment flexibility, the TFSA is a great option. And for long-term retirement planning, the RRSP is your go-to. Or, based on your financial goals, you can use these accounts in combination. You also need to remember, some accounts are tax-free, some are tax-deferred, meaning you will pay taxes down the road. However, not all accounts offer immediate tax advantages. In this video, we just scratched the surface. There are more details to explore about each of these accounts. Before you start on an account, make sure you understand about the contribution limits, withdrawal rules, and investments options available. This is the end of the video. Thanks for watching. Don't forget to like this video, subscribe to the channel for more personal finance tips, and let me know in the comments below which account you are focusing and why. Until next time, happy saving.